Well, let's now take a look at the broader economic outlook, and certainly the other consideration for investors right now is earnings season. We're in the thick of it. Let's get across what we're seeing. Darren Thompson joining us from Equity Trustees. Darren, welcome back.
Thank you. Great to be here again.
Let's first start a look at the economic picture. I mean, what are your observations? We've just been talking about, obviously, the threat of inflation. We're getting those numbers out of the States very shortly. That remains a persistent issue, certainly here in Australia. What consideration do you have for that, particularly, I guess, when you're making investment decisions?
Well, I think right at the moment, when we look at 2026, the outlook for economic growth looks pretty constructive, globally. Whether you look at the US and the stimulus that's coming through, the fiscal stimulus from the One Big Beautiful Bill, and in Europe through defence spending and other broadening of balance sheet, public sector balance sheets there, and even emerging markets seems quite strong. So the economic environment is quite sound at the moment. In Australia, we've got growth, but it's been the baton's being passed over from public sector demand into private sector demand, and certainly even out of the CBA result yesterday, there was some evidence around that in terms of the data that they're seeing from household spending and so forth, helping maintain growth. So the overall economic picture is quite sound. Obviously, we've also got thematics within that. The AI thematic is quite pronounced. Certainly, that's contributing to economic growth, but it's also leading to divergence between sector performance as well. So there's some really meaningful themes happening at the moment, but overall that expansion of balance sheets that we saw pre-COVID and has been maintained has probably lifted the values of all assets, but it's pretty constructive going forward.
Well, I'm interested to get your view on portfolio construction at the moment, bearing in mind what we're seeing with some of those sectors. You mentioned tech there. Obviously, we know what's going on Wall Street. Just looking at the local market again today, tech coming off significantly, has been pretty dire for the sector. Some of those quality companies too really taking huge hits.
Quality and growth companies have been really damaged over the last 12 months, and I guess what that reflects is when you've got long duration expectations of growth and there's anything that comes to question that, the longevity and sustainability of that growth, certainly can derate quite quickly. Anything that's had potential of being disrupted by AI has been particularly harshly felt. There's the talk of the Sassacre, any software-related company that potentially can be disrupted by AI. But that's also moved through into industries such as insurance broking, or even overnight it was into the wealth management and platform areas. So it's certainly a thematic that is calling into question the long-term growth of some models. How we're thinking about it from a portfolio construction perspective has been to be a little bit defensive, and names that have probably lagged to some degree over the last 3 years, but names like Amcor and Brambles and Telstra, where sort of they're real assets, and probably it's less easy to replace a pallet with AI. It's less easy to replace packaging with AI. So some of those businesses which are quite resilient, and expectations were already moderated. It's sort of areas which we are sort of looking to play at the moment, and waiting to see, frankly, how things shake out, because I think there's still some uncertainty as to how that AI thematic will impact business models in a range of industries, and I'm not sure that's fully played out yet.
Now, elsewhere, healthcare, another sector that has copped it in the neck as such. In particular, of course, we got CSL yesterday.
Yeah.
Disappointing results off the back of that shock announcement that chief executive's out the door. Now, I've been speaking to fundies and stock pickers. They've been saying, look, this is looking pretty compelling. And this was prior to what we saw. And then we saw that precipitous drop yesterday. It's down again about 3% today. Would you be buying at these levels?
We would. I'll come clean. It's a portfolio holding, so we've certainly felt the pain, and it's been disappointing how particularly the companies communicated to market. We had our analysts attend their industry day in the US recently, and obviously we keep abreast of both. We keep in constant contact with the company and its competitors. Overall, we would say that we still have confidence in the resilience of the markets in which they invest and the overall positioning of the company. However, certainly they've contributed to the current situation through lack of clarity and communication, as well as some headwinds that they're seeing in terms of policy initiatives coming out of the US in particular, some dynamics in China regarding albumin demand. But essentially, we still think that there is now really compelling value. It's more compelling value than it was 2 days ago.
That's true.
But essentially, we downgrade our numbers really slightly, by 1 to 2%, nowhere near as much as the market has derated. I think to some extent that's where some of the psychology of the market, if we've got to sort of be disciplined, where we see value being maintained. And I think the market has just got a bit sick of their disappointing announcements and the way they've communicated. We're looking to see through that and see the delivery.
And Darren, the exit of the CEO, is that a reset that's been slowly coming, or is it smack of panic perhaps?
Oh, look, I think it's I think the way they announced it was not particularly well ordered and actually led the market to feel there's a little bit of I guess a little bit of a reactive decision. But I think ultimately we would say that the execution of the business has been a bit disappointing over the last 12 months, notwithstanding the value of the underlying franchises. And certainly the way it communicated again was a lesson in how not to communicate to the market, how not to seamlessly order. We do have confidence in the interim CEO. He's someone who we've had interactions with and we think he's a good operator. And I guess pleasingly, we felt that the communication already took a positive turn in the call yesterday, where he certainly owned the numbers together with the CFO. That they were owning the numbers and they're really committing and stepped forward a very logical pathway as to why they feel they can deliver an FY26 guidance.
Darren, just before you go, interested to get your view on CBA. It's done it again. It sets that benchmark and has to beat it every time, and it succeeds in doing that. Shares up again today. A big rally yesterday. What are you thinking of it?
CBA is a company, it's sort of a metaphor that's coming to right at the moment. It's like one of the pole vaulters who just keep edging above a centimetre of world record at a time. It's performed really strongly. It's a great company. It's really priced for that, but certainly it did edge up. 6% earnings growth in really pristine credit environment where bad debts are really historic lows, and that's a credit to their credit quality, but doesn't get much better than that. 6% earnings growth is still not great for a 26 times PE. So great company, continues to deliver. I would still say that relative to their peers, it seems a bit expensive.